Talk to me about the rally that we saw, particularly in the last several sessions.
So I think two things were generally driving oil last week. I think the first thing is generally, as we saw on Wednesday, we usually see EIA's normal weekly reporting. And so that was clearly in excess of, the draw was in excess of market expectations. And then, of course, the geopolitical risk premium, which has been present for a while now, I think with Bolton's appointment is clearly, market participants are looking at pretty much an end to the JCPOA, the Joint Comprehensive Plan of Action, as of May 12th. And so I think the market pretty much assumes that there's going to be some kind of reduction in Iranian supply. I'm not so sure that that's the case. There's a lot of different things that Iran can do to kind of skirt sanctions. In the past, they've used more oil in their power sector. They've actually sent oil to different places that can take it, so there's wiggle room from their existing suppliers. But clearly the market is focused on that, and that's why we saw this divergence in equities and oil last week.
Well, Michael, even if there is a curtailment of the Iranian production, why don't we believe Saudi Arabia won't just up their production? We have a chart here, actually came out of one of your notes, showing the extent to which really what happened in oil overall was that Saudi Arabia absorbed the shock of increased Iranian oil production.
Right.
So why wouldn't they just reverse that if, in fact, Iranian production went down?
Well, if Iranian production went down, they, of course, could conceivably move back up to the levels of 10.2 to 10.5 million barrels a day, which they were at last summer. Right now, they're producing less than 10 million barrels a day. So I think there is some wiggle room, at least in terms of other OPEC suppliers, but they're all committed to this OPEC deal, and I don't expect them to diverge from that either.